This video briefly discusses financial statement analysis and problems with this analysis. Financial statements include three major statements, including the balance sheet, the income statement, and the statement of cash flows. Our goal here is to expand your understanding of the uses of financial statement information. A good working knowledge of financial statements is desirable because such statements, and numbers derived from those statements, are the primary means of communicating financial information both within the firm and outside the firm. Clearly, one important goal of the accountant is to report financial information to the user in a form useful for decision making. Ironically, the information frequently does not come to the user in such a form. In other words, financial statements don't come with a user's guide. One obvious thing we might want to do with a company's financial statements is to compare them to those of other, similar companies. We would immediately have a problem, however. It's almost impossible to directly compare the financial statements for two companies because of differences in size. To start making comparisons, one obvious thing we might try to do is to somehow standardize the financial statements. One common and useful way of doing this is to work with percentages instead of total dollars. The resulting financial statements are called common size statements. We construct common size balance sheets by expressing each item as a percentage of total assets. We also construct common size income statements by expressing each item as a percentage of total sales. The common size income statement tells us what happens to each dollar in sales. Another way of avoiding the problems involved in comparing companies of different sizes is to calculate and compare financial ratios. Such ratios are ways of comparing and investigating the relationships between different pieces of financial information. Financial ratios are traditionally grouped into the following categories. First is short-term solvency, or liquidity ratios. The primary concern is the firm's ability to pay its bills over the short run without undue stress. The ratios focus on current assets and current liabilities. Second, long-term solvency, or financial leverage ratios, are intended to address the firm's long-run ability to meet its obligations or, more generally, its financial leverage. Third, asset management, or turnover ratios, describe how efficiently, or intensively, a firm uses the asset we are measuring. Fourth, profitability ratios are intended to measure how efficiently the firm uses its assets and how efficiently the firm manages its operations. Our final group of measures is based, in part, on information not necessarily contained in financial statements, the market price per share of the stock. Obviously, the market value measures can be calculated directly only for publicly traded companies. We continue this video by discussing some additional problems that can arise in using financial statements. In one way or another, the basic problem with financial statement analysis is that there is no underlying theory to help us identify which quantities to look at and to guide us in establishing benchmarks. There are many cases in which financial theory and economic logic provide guidance in making judgments about value and risk, but little such help exists with financial statements. This is why we can't make a blanket statement about which ratios matter the most and what a high or low value might be. One particularly severe problem is that many firms are conglomerates, owning more or less unrelated lines of business. Vingroup or Mawson are well-known examples. The consolidated financial statements for such firms don't really fit any neat industry category. More generally, the kind of peer group analysis we have been describing is going to work best when the firms are strictly in the same line of business, the industry is competitive, and there is only one way of operating. Another problem that is becoming increasingly common is that major competitors and natural peer group members in an industry may be scattered around the globe. The existence of different standards and procedures makes it difficult to compare financial statements across national borders. Even companies that are clearly in the same line of business may not be comparable. For example, electric utilities engaged primarily in power generation are all classified in the same group. This group often is thought to be relatively homogeneous. However, most utilities operate as regulated monopolies, so they don't compete much with each other, at least not historically. Many have stockholders, but many others are organized as cooperatives with no stockholders. There are several different ways of generating power, ranging from wind to hydroelectric to nuclear. So the operating activities of these utilities can differ quite a bit. Finally, profitability is strongly affected by the regulatory environment. So utilities in different locations can be similar but show different profits. Several other general problems frequently crop up. First, different firms use different accounting procedures for inventory, for example. This makes it difficult to compare statements. Second, different firms end their fiscal years at different times. For firms in seasonal businesses, such as a retailer with a large Christmas season, this can lead to difficulties in comparing balance sheets because of fluctuations in accounts during the year. Finally, for any particular firm, unusual or transient events, such as a one-time profit from an asset sale, may affect financial performance. Such events can give misleading signals as we compare firms.